everyone, and we are live.
Psst, that dude right there, he's kind of a big deal, kind of an author, kind of knows some stuff about what we're going to talk about. So, ladies and gentlemen, let's do this. Truth Radio Live with my man Paul B.
Yo!
How are you?
I'm doing awesome. How you doing, Jesse?
Dude, that was a big yo. I wasn't expecting all that.
I was trying to blow you away a little bit there.
This guy, we flew him all the way in from Roanoke, Illinois,
Yeah.
Wichita.
My flight left 10 days ago. Yeah,
Good.
Yeah.
Good.
Just landed.
That's what they call the pilgrimages now? Flights.
Barely. Yeah. Flights.
Where are you from, really?
I'm from State College, Pennsylvania, the home of Penn State University.
Okay, so there's officially one person now watching that knows where that is.
And
it's your
middle of
mom.
Pennsylvania, yeah.
Or Jess in the back.
Right.
But the where is not so much as important as the what right now. So, gang, if you're in this space right now, called the domain specifics of trying to navigate a very tight and contentious inventory market. I think it's the same, probably true in your neck of the woods as it is over here in San Diego, and seems to be also a theme throughout the rest of the country. Low inventory, still got high buyer demand right now because the rates are good and people want to try to get their name on something before they feel like that ship is going to sail past them. And in the middle, you have a lot of frustration and a lot of meat left on the bone of desire for the folks that are actually trying to manage it and navigate it in the meantime. So got this dude on here because he done wrote a book. It's going to be a pretty good one. So I wanted to hack some of the best stuff out of that and get Truth Radio Live Nation some inside secrets. So let's start with the sell side. Okay.
Good.
So we need to free up some inventory. I don't want to butcher the hack, but what was it? It was the dream home deal.
Yeah.
So all
Well, so one of the main things that we're finding in the different markets where we work is that there are many people who want to move, but they think they can't find what they want.
Okay.
So the idea is, could you move and sell your home only if you were guaranteed to find the one that you really loved?
So the deal with tight inventory is not just that they don't want to move, it's that they're having a tough time imagining where they would go next.
Totally.
Okay.
Yeah.
Fueled by what? The elevated prices, of course the lack of inventory. What?
Yep.
Fueled by what?
Elevated prices, lack of inventory, just taking a look and realizing that most homes sell before they even hit the internet.
Mm-hmm.
They're there and they vaporize instantly, right? So how can you even keep up? And there's a lot of people who are so busy that unless they feel like they have the space to deal with that, it's kind of easier to stay put. And yet, there's the other point that there's amazing opportunities right now, right? So how do you balance that out?
Well, apparently with a dream home guarantee.
Yeah, exactly.
Right. So
nothing better.
So what's some parts on that? Let's pull it apart.
The idea of the dream home guarantee is that if the market is super hot and you might get a bunch of offers on your home, you could make the sale of your home contingent on finding the home that you really want. And there should be enough buyers who would actually want to sign up for an offer like that. Right.
Well, that's not a new concept, right? I mean, everybody knows that exists, and so in real time, there's challenges. You can almost think of it like a spectrum, and as the pendulum sort of shifts, you have a very sell-side biased end of that spectrum, and then you've got a very buy-side biased end of that spectrum. We're not going to go dive deep into the rabbit hole, but basically, one of the challenge with the very sell side is that it will probably come at the cost of the amount of money you're going to get for your home because you're adding integrated complexity. And at the same time, you're also probably going to paying more for your home if you're even lucky enough to get your name on a contract because it's so competitive on the buy side. No one wants to deal with all that contingency. Right. But you get a very lowered stress level in the process. Right. You can completely eradicate that, throw it out, have no contingencies on the other side, but then you might be couch surfing it at your buddy's house for several months if you don't, you can't find a replacement property. And there's some hybrids and stuff in between. So that's not a new concept. Right. But what's your new take on that concept?
Well, the new take is that a lot of times beginning to look at things that way is a great way to get into the market, right? To understand that that's an option. It may not be the one that you ultimately choose, but it's choice. You could decide to do it that way. And yeah, you might leave some money on the table. You might pay a little bit more. But then again, if you get your dream home and there's no stress, that might be worth it. It might not, right? It's more that that's a doorway to know that that's an option. And for many people who are stuck, it's just good to know, like, oh, I could do that if I wanted to, you know?
The guarantee of the dream home is the sense that you don't sell unless you find that up leg that makes your dream come true, right? So simple enough, right? So there is a form of contingency in there. But rather than just stating that, again, for a fact, and everybody sort of just rolls their eyes like, okay, great, glad I tuned in for that fact.
Right.
We've known that's there. What's the guts of that make it a little bit more so?
Yeah. So the guts of that is that you also, in that strategy, take some time to actually look at the financial side of things before making a decision about whether you can make the move or not, or whether there's even a home for you. So, you know, I'm finding I work in 4 or 5 markets around the country, and they're all very competitive. You know, San Diego's one, and what I've seen is that there's many people that with a little bit of financial strategy can afford much better than they thought and actually be in a competitive place that they never dreamed possible. So that's the hack, you know.
Good. So everybody knows, at least you better not, you've been living under the rock, you got to go get your finances in order before you ever hop out inside that lily pad in the first place. But is it safe to say that it's more than just getting pre-approved contingent on you selling your home? I hope so.
Way.
Right. So then this is one of your domain expertise.
Yeah, for sure. Yeah.
So let's pull through that a little bit. So share us how that looks like.
So one of the things, so you guys all know, I work with as a lender, as a consulting lender, with a group called Homeside Financial, and one of the things that we do is we're very into looking at the big picture, right? So there's 4 or 5 ways that people often overlook that they can actually have a move save them money, right? For example, one of them can be making very intentional decisions about how much to put down. There's the decisions about knowing what tax benefits would happen if you moved, looking at debt portfolio and freeing up cash flow, understanding what's happening with withholding. I mean, there's a bunch of things. You know, there's probably 10 or 12 strategies that we usually look at with clients.
So let's hit the down payment thing first, because the old axiom, of course, is that you want to have a healthy down payment so you can eschew the perils of mortgage insurance and
don't
a high
say
payment
that word, man,
and all that different stuff, right? At the same time, though, if you go into the annals of surveying any investment, principally house, stock, bond, mutual fund, or otherwise, you have to basis it on the same 4 tenets. So what's the safety, what's the liquidity, what's the rate of return, and what's the potential tax advantage?
Right.
So if you do that with real estate and then you attribute that to the dormant equity that's buried in your backyard, down payments don't typically stack up to be that smart money of a decision, right? Use the OPM, other people's money, try to get your hands on the biggest asset that you can actually service without getting yourself in trouble, and then hope that you can ride some appreciation up over time, maybe put some sweat equity, all that stuff, right? Cascades through. So what about down payment now might fly in the face of conventional wisdom?
Well, so one thing that we see a lot is that, like you said, PMI. Who wants to pay that? Nobody, right? So a lot of people think, I got to put all this money down to avoid that, right?
And my grandma's watching, so what's PMI?
Oh, PMI, yes. Well, it's not something that happens every so often. It happens all the time if you have it. It's a monthly payment for mortgage insurance, right?
Which means you're putting,
Yeah, if you put less than 20% down. And it's a payment that you have on most mortgages until you reach 78% of the original purchase price. And on some mortgages, like FHA or USDA, you have it for the life of the loan.
Right.
So
it's not insuring you, it's insuring the lender.
It's insuring the lender.
So the concept of putting as little down as possible to get the highest asset, you might be stuck or saddled with this payment, which is killing your cash flow, which again is maybe even a higher tenet principally of any investment is cash flow.
Yes.
Right. So
perhaps the highest.
Perhaps.
Anyway, some of the options with putting less down there are ways to avoid mortgage insurance. A lot of people don't know. One of them is if you have a good credit score, you can pay a fee up front to have it basically waived for the life of the loan. So it's a cost, but usually when you do the analysis, it's much less than the monthly expenses. And with a good credit score, the cost isn't that much. That can free up a ton of cash flow. And here's the thing, guys. Right now, with the rates being low, purchase power is super high, right? So every $1,000 that's financed is about $5 a month right now. That means $100,000 is $500 a month, right? That's how that goes. $10,000 is $50.
And then conversely, if you talk about saddling up for some mortgage insurance, every $100 of extra monthly payment is carving into about $20,000 of purchase price.
Correct.
So if you're stuck in a situation where you've wanted to move, you rode out the Great Recession, and you're back out. You actually made a couple bucks on your property again. It's time to get out. But then the property that you had in mind for yourself has also gone up as well. This is a way to potentially carve out a little bit greater of a purchase power with a mortgage plan versus just walking into your bank. Sorry, banks. No disrespect, but then just pumping out a pre-approval based on credit score, income, and down payment.
Right, because here's the thing is to be active in the planning of this, right? To understand that there's other things involved. So if you show up at the drive-through, and you say, I want a burger and fries, you're going to get a burger and fries at a bank, so to speak. They won't really give you a burger and fries.
I just got hungry.
This is a cool bank. But anyway, my point is that if you go in and say, oh, I want to know what all the options are, I want to know what my choices are. So watch this with mortgage insurance, to get back to that. You can buy it out up front, but also by splitting a loan into two, you can avoid it as well with as little as 5% down.
But the old rub on seconds is that you're going to be paying a higher interest rate.
Not necessarily true. Right now, with good credit scores, actually, many of the ones I'm seeing have a lower rate than the first, believe it or not, yeah, because they're tied to prime. So if your credit score is good, you actually may have a lower rate on the second than you do on the first, counterintuitively.
With maybe a little bit higher variability, but you could also close in those as well.
You can close them in, yeah, you can close them in. So to take this one step further, right, imagine that you maybe have, you were talking about $100 a month giving you 20 grand more in purchase price.
Right.
But let's say that there's a car loan for $400 or $500 a month, okay? Or 2 credit cards or whatever, a couple loans, right?
And these aren't things people are typically thinking about.
No, not at all. Imagine that you could sell your home, free up that equity, right, and then pay off those 2 loans. Maybe you pick up $500 a month by putting a little bit less down on the property. Still don't have mortgage insurance, right? If you can swing 5%, you can avoid it either with the buyout or splitting it between first and second. And that freeing up a $500 a month, well, that gets you 100 grand in purchase price, right? That can really change somebody's purchase power. So I call that debt portfolio. The idea is looking at your debt overall, looking at it as a portfolio. And it's a big mistake a lot of people make, looking at their debts one by one. Most people are like, well, I got a good rate on this one, and that one I'm trying to pay off, and they get very splintered in their thinking. Where really, if you're looking at debt, and you're looking at your expense overall over time, it's how much interest you pay on all of it that matters, right? Who cares if you save a little bit on one and get killed on another one, right? So a lot of times looking at that as a portfolio can really work.
So you mentioned the potential for debt portfolio restructuring, even kind of delving into like the consumer element of it, just to make sure everything's all cleaned and tidied up. Yep. We talked about not having to put or not having to saddle yourself with mortgage insurance. You can either do the upfront mortgage premium, or you can break it out with a first and a second mortgage. Yep. What about like tax savings and stuff? Are you able to kind of even forecast that into a potential thing to work that backwards?
Yeah, for sure. So the tax savings is a huge thing that a lot of people miss, right? And so basically, most people are looking at their budget based on their reality today, and they don't think about what happens if they buy up. So if you buy up, you get a bigger tax write-off, right? And a lot of times what we do when we're working with a client is we actually help to calculate that, at least approximately, right?
Because you're not a CPA.
Yeah,
but
CPA is going to do it precisely, but we can certainly look at that and be in the ballpark enough to be like, wow, so think about this. If the property taxes on a move up are more, and the payments maybe a bit more, there's more interest, right? Those things equate to tax savings. That could be a couple $100 a month. And what is that? That's purchase power. That's being able to pay off other debt more quickly. There's choices with that money. And it's money that most people in their thinking leave on the table. They don't even bring it into the equation.
Well, and what I'm picking up from you is more of a larger conversation, just in one of approach, in one of almost as deep as you could go ethos on it, but definitely practical theory, where you are either an order taker that's just processing information and spitting out a result, or are you actually taking the necessary time to sit down, ask the thought-provoking questions, make sure you have a full understanding of the buyer's total pecuniary profile, and then be able to actually surgically pinpoint out the things that might need to get cleaned up. We didn't even talk about credit.
Right.
That's kind of a low-hanging fruit. Most people know about that.
Right.
But I mean, most people's credit profiles have at least 1 or 2 egregious errors on there.
Right.
Or a parking ticket that you paid 5 years ago that's a judgment now.
Right.
And these type of things. And if you walk into an open house, you fall in love with something, you don't have the plan in place.
Right.
And then you just got to get what you got to get. It can take a long time, sometimes maybe never, to unfurl the damage that you caused by not having the time to have a plan in the first place.
Yep, for sure. And I think one thing to know is that lenders, many of them, can do modeling on a credit report and let you know what can be done to improve a score. And so that's a cool thing to know. A lot of people don't know that. Why that matters is, if a lot of times bringing a score up is actually simple. It's not that hard. Like, it could be something that doesn't take a lot of money. It could be something that doesn't take a lot of time. I see a lot of cases where that can be done immediately. And the reason that matters is if that saves a bunch of money in closing costs, it drops a rate, that affects purchase power. It's a huge thing. So credit's a big thing to make sure that you're not just learning what your score is, but specifically how to increase it. The gold standard is you want to be at 740 or above.
Yeah.
740 or above, yeah, that's the sweet spot.
Gang, Paul Berkobin, he's a mortgage planner and consultant with HomeSmart, and we'll go ahead and put his contact information down below. Also, co-author of the upcoming book, theownerbook.com, where he's going to be playing out, of course, all these great theories and practices which you can apply right now in today's market in real time. Thank you for that, my friend. Let's take the same category of home seller, potentially, maybe pent up. They didn't know they could do. They didn't know they couldn't do that. Maybe they have that same conversation and they realize that they want to stay.
Right.
But they're tired of their house, which means that they go into what mode?
Oh, it's time to renovate.
It's renovation mode,
yeah,
right?
You gotta do
so,
that.
so what kind of ways can you still help folks that don't actually have a move, as a result of the consultation to figure out what the best options are in store, but rather stay, but then renovate, right?
Yep.
So how would you approach that client?
Well, so there's a lot of things that are similar. One of the key things is actually starting with the realtor, in getting a really clear picture from your realtor on what the cost-benefit analysis is of potential renovations. Do they make sense for the home you have? Are you going to be priced well within the market? All of that kind of stuff. There could be renovations to leave on your list and some maybe to take off. Right?
Yeah. Well, even one of the viewers we had tuning in a little bit earlier, Alan Riebensdorf, we were talking to him over the weekend. He's a contractor realtor out of Arizona, and he was talking about different websites and resources that you can actually use, like cost versus benefit or something like that.com. There's several of them. But if you look on any or all of them, you will see that it's very difficult to get a return that's at least the $1. Most of them are quite off so, right? So if I'm putting $1 out, I want to make sure that I'm getting at least that buck back.
Right.
So there's this concept of synergistic returns, where if you could just do the front door, that might cost $400. I might not be able to get you that $400 back in a home sale. But if you take that, you combine it with some woodworking and some termite stuff, and actually you're painting the outside and you're putting shutters on, whatever the case, landscaping, the synergistic return actually ends up compounding the results, and then you actually get the return that you're looking for. So the agent can kind of help you gauge market position and see like where you're at right now. That would probably be step one to figure out if they even want to sell or they can sell.
Right.
And then the other part of that would be kind of guesstimate, hey, if you did X, Y, Z, I could probably get you 1, 2, 3, and you could do the cost benefit analysis. So that's from the agent side. What about from the lender side?
Well, so from the lender side, and there's a bit of a segue from the agent side, a lot of times when folks are thinking about a renovation because they want to stay, it's usually going to be a bigger renovation, right?
That's a good point.
Yeah, it's usually going to be something more major. So part of what the realtor is saying as well, where are you going to land with this? Same thing from the lending perspective. Is there going to be equity in the home after making major renovations? Are you potentially over-improving, which would be, something we all want to avoid. Anyway, from the lending side, though, it's a similar conversation of looking at the bigger financial strategy, because the time of renovation is often one where you're either going to be ponying up cash, and decisions around that are often made very haphazardly from my experience. It's, the local bank has a home equity loan, on special, and it can convert to a fixed rate. That's probably good enough, And the same things we've been talking about apply. How's the debt portfolio? What are the taxings? What are the withholding strategies? Should you come out of pocket for cash or not?
We're getting deep in the rabbit hole right now of a very complex conversation. But the gist is, don't just make the mistake that you see too often made, where people just sort of default to walking in, making deposit at their local bank and then just walking over to the desk, signing up for the home equity line of credit.
Right.
That might be your best option,
Right.
but what you're suggesting is there's a couple other things you might want to do advance, kind of similar to what you even talked about a second ago with
it's very similar.
figuring out what your purchase power is, if it's actually time you could free up to move.
Yeah.
Because you said it best, man. If you're just getting the home ready for sale, that might be a $4,000 budget,
Right.
maybe 500. You know, definitely less than 10. You try to keep it to make sure you get your returns back. But if you're staying, oh, dude, you're hitting the kitchen.
Come on, man.
You're going baths. You're going wet
yeah,
areas.
yeah.
You're looking at 50 to 100.
Oh, yeah.
Where it gets sketchy with returns.
Yeah.
Right? Now you're paying full GCs. You're getting the county involved. You're getting the county involved, right, guys? You're getting permits. elbow. Right, and there's a lot of room for error in that stuff. So a financial plan actually becomes even more critical in the sense of figuring out where you're getting the money from.
Yeah, for sure.
Yeah.
And some of those things, you know, they may be a lot for enjoyment, but not so great financially. And that may be okay. You know, it might be like, well, I'm gonna invest in this because I want it.
Yeah.
But at least know where you are. You know.
The spaceship skylight.
Yeah. Yeah. Well, you know, the yurt out back, man.
Oh, the yurt out back.
You gotta have the yurt out back.
Yeah.
It's
for the Inipi sweats.
That's what I'm saying, man.
Yeah.
You know,
Yeah.
these things are key.
Hashtag no one knows what the hell we just said. So the other thing also.
Hashtag how to make big money.
Yeah, there you go. There you go. That's your next book.
Yeah.
The other thing on that also is event or horizon.
Right.
Not when the machines take over.
Right.
But more importantly, like how long you plan on staying in the home.
For sure.
Right? So
For sure.
how this kind of cooks back into the same conversation. I hate to have overlap on this, but like there's a very real law of diminishing returns when it comes to time.
Yep.
Right? So for example, just from the raw appraisal perspective, you know, appraisers love it when your stuff is upgraded, right? So they can then put you into that next little class of condition and kind of push value and feel more comfortable and emboldened by that. But truthfully, 24 months is a critical window.
Yeah.
If the improvements are older than 24 months, you know,
Nice
the
house.
receipts are nice to see, but
Yeah.
they're not really taking the dollar for dollar stuff on the actual hard materials anymore.
Yep.
You know, and then you got labor, and you don't quant labor.
Nope.
You know, unless it's an actual corollary to what the guy next door sold for, and then you're just lucky.
Right.
You know?
Exactly.
So these are all important things for event horizon.
Yep, they are. And that's where the financial plan comes into matters too, because sometimes what you might think is your horizon, when you have some of these other details, you might have a different you know, idea after learning those things, right? So I think that, you know, having that financial piece is really important. And one key thing I would say about that is when you do that, if you want to think about it like an overarching idea, it's thinking about how renovation is going to leave your cash flow. You know, that's just a key thing. How's it going to leave your cash flow?
Yeah.
When you're looking at that structure, you know.
So, gang, Paul Berkobin, home smart advisor extraordinaire. He did wear pants today, which is good.
Barely.
Yes, thanks to Jess, I think, left the house. You want to check him out also by getting on the pre-order for his new book. He's co-authoring The Owner book.com. The funny thing about what Paul is actually an expert at, it just so happens he's well versed in those categories of trying to maybe take something that you thought was a fixed object or inanimate and actually give it some life and breathe some new oxygen into somebody who wants to move but doesn't feel like they can or they're stuck. What about the other side of the coin, right? I mean, this is really where, this is the sweet spot for you. Like, you excel, my understanding of you, in buyers, in your consulting, in your availability to not only make sure you're optimizing people for what they qualify for, but also getting them through the process in an incredible short manner, which is critical right now, and then having a really great experience. Man, 10s out of 10s across the board from everybody I've talked to, you've worked with. But what are some hacks and strategies that somebody's actually passively watching in right now can apply in their situation to the, again, tight inventory, pent up, multiple offer, getting into summer market that we're in right now?
Right.
There's always two markets happening at all times, right? Yep. There's the flash bang of what's real and what's happening right now, kind of the stuff we just sort of mentioned. Right. But then there's also like these fundamentals. Yeah. There's these things that'll carry through or forward in any market, irrespective of the year frame. And if, in my understanding of what you've always preached, is that if you practice these, the rest takes care of themselves.
Yep.
So let's kind of walk through that a little bit. So pretend I'm new to that conversation.
It's a great way of saying it, and I think that part of it is the idea of knowing that there are habits of successful real estate investors.
Yeah.
You know, and
any buyer, you could argue, is an
any
investor,
buyer,
right?
Yeah, for sure. Oh, for sure.
Yeah.
Any buyer is an investor.
Right.
At least in one sense of what they're doing. So there's habits of that. And what happens too often is that folks get swept up into action before really having taken some of those habits on, right? And so
Say that differently.
Yeah.
How would that play out?
Well, I like to say that some of the funniest decisions that I've ever made, if I look back in my life, I was idealistic and I just jumped into action, right? Like that's the model. That would be the diagram, rather than going through a process, right? And it's kind of like, going to the store and just buying something, right?
Ah, yes, the old mall metaphor.
Yeah, the mall metaphor, right?
Yes.
So, if you decide you want something, it's real easy to go get it in our world, right?
Right.
You could just go do it. So, but the thing about homeownership is it's a little bit different, than buying something at the mall. And there's a lot of money to be made or lost, a lot of basically, opportunity in life to be made or lost by being prepared before you get to the mall, right? So,
or understanding, at least more critically, that the process at the mall metaphor is played from the event that it's happening forward, and
Right.
it's a short stroke. Whereas buying a home is a long stroke, which means it's the proper planning preventing the poor performance.
For sure.
Right? Before you actually get to the move on the chessboard,
Exactly.
the work that you've done in advance leading up to that is directly proportional to how well the game is going to be played.
Yep. Yeah,
It's
for
not
sure.
an instant gratification market.
No, it's not. And I think it's really interesting, several years ago I read a study that was done by Deloitte about a bunch of its like big Fortune 500 company, clients, right? And they were looking at how they apportion resources when they're taking on a big project, So Exxon is deciding to do some big thing and they've got, millions of dollars to do it. How do they split that up? And the simple sort of take-home point of that whole thing is that a lot of what they saw was that on a big project, some of these organizations would attribute as much as 80% of their budget in the planning phase, right? And only 20% in the execution, And I think, these are among the most successful organizations on the planet, right? So there's something maybe to emulate there, right? They're not just going to the mall,
Yeah.
And there's something that comes first.
Because it's about patterns over the minutia.
Yeah.
Would you say that's safe to say?
Absolutely true.
Right. So, okay, so then walk me through that. So I'm a buyer. I'm raising my hand. And it doesn't matter where I'm at in the process. I don't care if I've been looking for 6 months. I don't care if I'm already woven into someone else's process and protocol. I don't care if I'm already pre-approved for written offers, or this is literally day one that they're catching this message.
Right.
Let's pretend we've got the fresh start button.
Right.
Okay?
Yep.
So what's the correct way to approach it?
Yeah, so there's a few really important patterns. One of them is building your team first, right?
Which is what no one wants to do. Now, let's be honest about that, right? So that's a very counterintuitive thing.
Yeah.
And it also can appear very self-serving.
Yep.
Because you're the team.
Right.
Right? You're wanting them to touch base with you first. Obviously.
Come on.
Let me control everything from the beginning, right?
Exactly.
But the reason that's critical is because...
Well, there's a couple reasons. One of them is that this is a more complex process, and it's one that, there are a lot of tools that are instantly available. I mean, one can go find things instantly, online, all over the place to sort of become their own expert. But the truth is that it's one of these things where the expertise of somebody who's really worked this through many moons is far beyond what one can do on their own. It's just there's nuance to this game,
Yeah.
And that's where money is made and lost. That's where you get really the right home, or maybe one that's just okay. That's where you catch the market just right, or you don't. It's where you win in this market, where things are so competitive. So part of it is that there's other shades of meaning to that too, though. It's not just any team. Like you could go hire a salesperson, right? Have a salesperson on your team who's going to just sell you something, and that would be terrible, right? So it's not just team, it's like the right kind of people. Who would you want, right?
Yeah, I think this is one of the most difficult things to impregnate into the idea of somebody who's going through the process completely autonomous of it. It's almost an impossible thing in my experience to try to almost like put on like one of those head things where they can flash forward into an unknown future that hasn't happened to them yet, and then reverse engineer the experience backwards to have them realize by themselves why it was so critical, arguably the most critical thing out of all, like how you start is directly proportional to how you finish.
Yeah.
You know, it's like the medical industry. It's not that we're at a loss of incredible devices and tools and machines. It's a misdiagnosis of the wrong problem in the first place.
Yep.
And you don't even know what you don't even know.
Right.
And then there's this whole bias. Anyway, so, right.
Oh, no, for sure. And there's the bias, and there's even the I think the perception that could be overly complex, that it's simpler just to just do something, just go to the mall, just make it easy, right? But
and all learning happens through direct experience.
Yep.
So how do you even really know if it's the right team?
Right. Well, and so there's a bunch of hacks to that, but one of them is really getting a sense of who you're talking to. If you're interviewing potential team members, you know, what's their perspective? So there are people who are on one end of the spectrum, very into just selling for any cost. They have their own agenda. You can usually tell those people when you talk to them. You know, that the ones that are maybe tougher to understand is, are you talking to somebody who is really asking you insightful questions that are looking at the short, medium, and long term? You know, is the person you're talking to somebody who helps make you think? That's a great distinction, actually. You know, there are professionals who are really good at getting transactions done. You know, they're like brilliant concierges, right? And you feel great talking to them. They're pleasant. They're easy to get on the phone. They return emails right away. All of which is awesome, right? Yeah. But are they really asking and digging into the bigger picture? And the point is that somebody with more of a consulting role or mindset would be somebody who would ask thought-provoking questions, right? Yeah. And that can be a huge piece of leverage. You know.
So what I'm kind of hearing you say is that, like, it's a feeling for sure, but to actually put this into practice, it's the distinction of the consultant versus the salesperson. Yeah. A salesperson is someone who's typically, so if you're like how to spot them, right? They're driving their opinions through their narrative. Right. So it's like if you're being told, you're being sold.
Right.
If you left a meeting with somebody and you feel like you just got presentationed, that's a salesman. Absolutely. And I'm not saying there's anything wrong. It's different strokes for different folks.
Right. For sure.
But what your contention is, what I'm hearing you say, is that the consultant is the person who is going to exist, at least in that moment, God willing, to be the smartest person in the room. What's the smartest person in the room do? They ask the best questions.
Exactly.
So do you feel like you were heard?
Right.
Were you listened to? Did you get put into a situation where you were asking the kind of questions that a typical salesperson would ask, where everybody knows the answer to? Or were they thought-provoking, no one knew the answer, and you were in an actual conversation or a dialogue? Right. That could be a good little hack there.
It is a hack, you know, because that's a sure sign that you're dealing with somebody who's got the bigger picture in mind, who can really hear you and ask those kind of questions. Yeah. And you know, that can have far-ranging effects. Like, I'm thinking about a story of a client where you know, they were working with somebody who wasn't a consultant, and basically what happened was they were coming up against their budget, right? So they were sort of getting frustrated because they couldn't find what they wanted in their price range. And that person basically, you know, sort of suggested, well, you know, you can move a couple towns over and get something that fits the price range. And after enough frustration, they decided to do that. And, you know, they got something that was 20 minutes more commute and needed more work and so on and so forth. And they realized, you know, this is a person who told me their story 3 or 4 years later when they had, and this speaks to the benefit of hindsight, right? So they had this benefit of hindsight where they were like, wow, that was incredibly expensive for us because we put all of this wear and tear on our vehicles, we put wear and tear on ourselves, you know, we ended up getting into debt because of it because it cost more to fix up a home. And they learned later, you know, after they had some more experience, we actually could have afforded more if somebody had asked the right questions, you know. And that's what happens a lot of times for folks. And even more so now where the market's tight and you have to make quick decisions.
Yeah, that's true.
Right? You know, it's like you really want your pregame on, you know, big time.
One thing that I also see in terms of the hindsight, maybe unfortunately after the game is actually played, is overpaying.
Yeah.
Okay?
Right.
Now you're triggering this from the market right now. So, you know, there's two sides of that. There's overpaying for the home and there's overpaying for the loan.
Yep.
Right? So in a market like this, which is really competitive, where you're seeing a lot of people have to make multiple bids and offers, and again, these are principles, right? So there's going to be difference to every little micro market, but at the same point in time, there's truths that you can draw through to any context. Yep. But if you're in a situation where it's a multiple counter offer situation, I'm not talking about the list price. I'm just saying the value you've placed on the home,
Right.
where you've had to go up over that comfort zone in order to be competitive, right? So some people, it just is what it is. It's the
Right.
home you fall in love with. It's the one you made 10 offers, you got told no, this is the level, and this is the one,
Right.
right? And so you're gonna follow through with that. What about from the loan side, though?
Yeah.
How do you overpay for a loan?
Well, counterintuitively, a lot of times you overpay for a loan by going after the lowest rate.
Okay.
Okay, how's that possible?
Right.
Well, the reason that's possible is there's a lot more to a loan than the rate. Of course, if everything else is equal, everything is equal, then the lower rate saves money. But there are also things like what is the mortgage insurance costs, if any. There's things like, did I time the market right? Because what a lot of lenders do is just lock a rate in right away with not a lot of sense of market timing. There's the question of, did I put the right amount of money down? Which we were talking about earlier from a potential seller's perspective. That could have you paying way more in interest. I'll give you an example. So a recent client who wanted to put a very low amount of money down because they were trying to keep liquidity. A lot of people want liquidity right now, right? So those guys had this in their mind that they needed to do an FHA loan, 3.5% down, save cash. And ironically, when we really looked at it, they were better off putting more down. And the reason is it made their monthly payment lower. Why? Because we got rid of the mortgage insurance, right? Now, there are a lot of salespeople who would have said, sweet, you want an FHA loan, you qualify for it, just here you go, sign here. But in this person's case, by putting a little bit more down, so in this case, we took some money out of a Roth IRA, not much, 10 grand. Okay, so within the exclusion, no penalty for that person. That allowed them to then not have mortgage insurance, which saved about $150 a month. And in the end, what happened was we looked at their Roth. By the time that the loan would be up, they would have over $100,000 more by being able to contribute more, right? So in a way, they would have overpaid by just following the quick trail, or in their case too, they could have taken those savings and prepaid the mortgage. And for those of you who don't know, if you pay extra on a mortgage, it saves a lot in interest. And so in this case as well, the savings would have been over $100 grand.
Yeah, wow.
And
for the life of the loan, you mean? Yeah.
Yeah, for the life of the loan. And so, and this is a person who's going to stay in that home long term. That's his plan.
Right.
But the point is that person just on their own going like, I need to find the lowest rate on an FHA loan.
Right.
Would have gotten none of that insight, right?
Yeah.
And in this case, would have overpaid $100 grand. So.
These are all the concepts that you're going to lay out, or that you have already laid out in your book, The Owner. Yeah. And you can learn more information about that at theownerbook.com. So let's do a little rapid fire, right? Because I know we're coming up kind of hard on this, but I want to try to get just some sort of quick insight from you. So what about the concept, like we talked about, like overpaying? Mm-hmm. What about like underbuying?
Yeah, underbuying. That's a rough one. And it happens a lot.
And that's counterintuitive.
It is, yeah.
Because everybody's taught, don't bite off more than you can chew. That's how you get in trouble in real estate. Right. So where is the other side of that sword?
Right. Well, certainly, don't bite off more than you can chew. The problem is that's often hard to figure out where that line is, right? So, underbuying can be not getting quite enough space. It can be not getting the best location, right? Location. It can be getting something that needs more work. Often I find people are blinded by their budget. They're not aware of the fact that by looking at some of these things we've been talking about, the tax savings, debt portfolio, how much to put down, whether to split loans, right, that they end up underbuying. Yeah. And some of the most successful clients I've worked with, who I can talk to 20 years after they bought their home and see what's happened, these are guys who bought enough. So for example, if you think of it this way, in a very simplistic way, even just saving the closing costs of having to sell and buy again in 4 or 5 years,
right,
is a chunk of dough. Yeah.
There's also, especially the sell side with the agents.
Yeah. Right. And there's also the fact that at least right now with rates being low, having to move in another market where rates might be higher can be incredibly expensive. Yeah. A 1% difference in rate can be a 20 to 25% difference in interest over the term of a loan. A lot of people don't realize that.
Not to mention on the street of the purchase power. I want to try to wrap it through something, because obviously you can see, gang, this is a book you're going to want to get, right? Because this dude, I got to quell him on these. But like, what about tools? Yeah. Okay, like I kind of think of like the spectrum of tools versus trust.
Yep.
Okay, a lot of people
Ooh, I
like
love that. That's
yeah,
awesome.
they like to do it on their own. They're
Right.
sort of the self-guided man or woman.
Right.
How can that get someone into trouble?
I think one of the biggest ways that that can get somebody into trouble is not knowing what tool to use when. It's complex enough that there's no there's no mortgage calculator that shows you the right way to set up your finances, for example. Finding the right home is not as simple as doing an online search. In Zestimates, not super accurate, right?
Yeah.
So I think tools can be useful for learning and getting perspective on a market, but I don't know that I would be using them to actually do the final interpretation of strategy.
It
right?
gets the conversation started,
Yeah,
you could
and
say, right?
It's great for getting context about things.
right.
It's, tools are for bigger picture, but not for the cutting edge.
That's great. That's well said. There's a concept in the information age that while everybody has all of it now, what's missing is the consciousness being sprinkled on top of it, and having somebody ask what's important to you and then repeat back what you heard you say and then place it inside the context of the information.
Yep.
Like the internet allows us now to have winners and losers.
Yeah.
We don't have the gatekeeper deal anymore in real estate, but
Right.
now the other challenge has actually been given birth to as a result of that.
Right.
Too much information.
Right.
Right?
Yeah.
So anything else from the rapid fire stuff that you want to?
Well, I think that right now, now talking about this market right now, where things are so, sort of tight, and what do you do with all that competition, is to know that the team is more important than ever, right? And that a great buyer's agent can help you know what to actually spend on the property, what not. A great lender can write pre-approvals in a way that help you beat out the 12 other offers on the house you want, or 20, And we see a lot of success right now on that tools versus trust continuum, by having the right strategy in place for this market.
Yeah. Gang, Paul Berkobin, co-author of the book, The Owner. You can go check out more information about that over at theownerbook.com. There's also going to be workshops, I understand.
Yes.
Maybe some in San Diego coming up, hopefully, and then also some back home over in Pennsylvania.
Yeah, for sure.
So learn more information about that. Can I end with the Donald Trump handshake?
Let's do it.
I'm dying to do that, where he goes underneath and yanks you forward like
so
that.
Good,
Yeah.
man. It'll pull me forward.
Super awkward. Gang, thanks for hanging out. So, my man Paul Berkobin, how is someone going to get in touch with you privately there? That is actually a completely inappropriate way of saying that. I hope you know what I meant. Offline.
There's two answers to that question. I'll give you both right now.
Yeah.
So, Homeside Financial and Go Homeside, Paul Berkobin, or P. Berkobin, excuse me, at gohomeside.com.
Yeah, cool.
Or just P. Berkobin at Go Homeside.
Sounds good,
Right on.
gang. All right, so until next week, thanks for checking out.